Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to the OptionsInsider.com's exclusive coverage of the 2009 Options Industry Conference. Coming up next, we have the Great ETF Migration Panel. Panelists for this session include Andy Nybo from Tab Group, Scott Burns from Morningstar, Jamie Farmer from Dow Jones Indexes, Sid Jane from Keefe, Bruyette & Woods, and Rob Stein from Astor Financial. Thanks again for listening, and stay tuned to theoptionsinsider.com for more exclusive coverage of the 2009 Options Industry Conference.
All right, good morning, everyone. We're going to get this back on course here in a second. Hope everyone is enjoying themselves and is ready for golf this afternoon. All right, next up for our sessions, the topic is the Great ETF Migration. I guess time will tell if we've named this properly, as a migration is a temporary status. Who knows, maybe this will be the Great ETF Immigration, where they don't migrate back. In any case, with that, the Great ETF Migration, the moderator, Andy Nybo, Head of Derivatives for Tab Group.
Thanks, Todd. Good morning, everyone. Thanks for coming to our panel today. We have a great group of panelists and a fantastic topic to talk about. A lot of people are thinking about ETFs, leveraged ETFs, and the options market, the interaction. ETFs have close to $500 billion in assets currently, and they make up about 40% of trading volume in the equity market. So it's a huge marketplace. It's growing. There's almost 1,000 different ETFs out there. A couple more added, seems like, every week. You guys are probably more familiar with that than I am. But again, my great panel today. To my left, we have Scott Burns with Morningstar, he's a director there. Jamie Farmer with Dow Jones Indexes to his left. Next to him is Sid James with Keefe, Bruyette & Woods. And another name, all the way last but not least, Rob Stein. You may be familiar with the name. Everybody has his book in their conference packet, so I'm told he's going to stick around and sign some autographed copies this morning. So, again, thanks for coming. First, I'll throw a big question out there. Why is there such dramatic growth in ETF, so much interest in the product, and why is it growing so rapidly? Scott, I'll turn it right to you.
Well, there's really two primary uses for ETFs, and one is kind of a substitute for mutual funds, and I think the other is a substitute for stocks. Coming from Morningstar, a lot of focus that gets addressed to me is how ETFs are substituting for mutual funds, and that has to do with their tax efficiency and the low cost and the liquidity during the day. But as a substitute for stocks, you have the diversification, with all the market turmoil we've been having, and it's also allowed people to say when they're investing, look, what I really have is a macro view. I have an industry, sector, asset class view, and I don't really want to dig around and try to figure out which company or smaller group of companies is going to give me that exposure. With an ETF, I get a nice diversified portfolio. The macro trends are going to drive everything, and I don't have to worry about, say, in the financial sector, which one of the banks has potholes. I know that it's out there. I just don't want to have to guess. So it's that diversification, and the liquidity is a huge part of it.
I mean, there's a couple of things to add to that. I mean, from a portfolio management standpoint, they're incredibly efficient. From a retail investor standpoint, they're generally low cost. They have some tax incentives to it. But from a trading standpoint, many ETFs are, I don't even know if this is a word, but arbable. You can create a trading strategy that could try to create a basket that correlates highly with it. There's option strategies that you could create, or even just the true arb of being able to buy everything in the basket at a cheaper price than you can sell the basket. The ETFs that become more liquid are those that the traders are involved with, and I'm a big proponent of that, helping create efficiency and liquidity. So you've got two audiences for it. You've got the people who use it as an investment vehicle. We have a belief in a particular sector or asset class. And then you have the trading community that thinks that there's some inefficiency in the pricing of either the ETF or the underlying securities that make up that ETF. And it's come together to create terrific volume and growth in a product that I think is probably one of the top 5 products Wall Street's ever come up with.
I'd echo a lot of those thoughts, and I think just the elegance of the product structure is a big component of it. It's very straightforward. It's very transparent. It's easy to replicate. It's rules-based. That leads to the liquidity. And I think a lot of the issuers as well have done a very admirable job of getting out there with feet on the street, trying to extol the virtues of ETFs. And as that market has developed, I think we've started to see a greater uptake, obviously, in the acceptance of index investing overall, and this structure just makes it much more easy to put that type of investment thesis into play, and allows for obviously much greater diversification of investment classes, of investment types, of themes, to put those into the market much more quickly in a structure that is easy to understand and easy to affect.
I think I echo all these points, but one thing that stands out with ETFs, which was not clearly evident when you think about 1993, the only investment vehicles people had access to as individuals, you guys in the room, was the S&P 500 or the mutual fund access market. What ETFs have typically done, as you rightly said, Andy, was creating thousands of such products. Not everyone is trading liquidly, but what it has done is given you guys, the individuals, the choice. Do you want to take a mutual fund on and let that manager decide what you want in your basket? Or 2, if you have an IRA, because 401ks do not allow ETFs, you have the choice in selecting now. I want a broad market cap like S&P 500, or I want a financial sector and I can split it up into any different sectors and manage that risk. The empowerment through ETFs, which is why you're seeing trading volume 40% and more so on a dollar basis, is because of that empowerment that retail and market makers like yourselves have seen through Arbable and whatever reasons, that decision-making directly rests in your hand and not in the active management hands.
Okay. Energy ETFs, financial ETFs, a lot of volatility in those markets over the past year. Has that the creation, the managing of the ETFs, has that kind of had an impact on the risk management capabilities? I mean, Sid, you're very involved in the financial sector.
Andy, from the financial sector, I'll just illustrate 2 parts. Firstly, the traditional ETFs, which are the 1x long ETFs, they still have the much bigger market share. 60% of all traded volume, which is just the volume, not the dollar volume, traded volume is all 1x traditional ETFs. But if you go and look at dollar basis, it's about 65%. What is the remaining? The remaining is the new launch of the leverage and inverse ETF world. The 2Xs, the 3Xs, whether it's directions, it's pro shares, whichever it may be. We've done our analysis, and this is contrary to most people like my counterpart at Wall Street, Dow Jones Indexes, but his Wall Street Journal newspaper has articles written by different people saying leverage and inverse ETFs are causing the end-of-day trading gap. We've done our analysis, and we've seen that is not the case, at least from the index standpoint.
I don't believe so either. It's hype TV that's creating that notion, I believe.
Yeah, and I want to pick on Todd, which you said yesterday about the swine flu and the whole panel that talked about media. Over here, it's not the media. It's the market makers who are trying to chase that end-of-day gap that these leverage ETFs have to chase to get to buy in and rebalance the basket. But just to get to the main aspect, financials as a sector, today, if you look at all ETFs, sector ETFs, the biggest volume and the biggest assets under management are in financials. And there are 4 ETFs actually that have 90% dollar volume and 80% trading volume. That story is telling you one thing. People migrated from trading individual stocks to ETFs. What have we seen additionally? People trading individual equity options are now moving towards ETF options, just to avoid that intraday volatility or a shorter volatility periods of time, such as right now we are in since September of last year. So we see that as a bigger trend of migration, and that's more so because people do not want to see that short-term impact to their individual trading loss position, like 40, 50, 60% in one stock exposure. You want to add on the energy side?
For similar reasons. As a portfolio manager, the ability to create exposure to an asset class and not have the concern of an individual company's earnings or issues that an individual company have makes the job of a portfolio manager significantly more efficient. You typically had to determine whether you wanted to be in the financial sector or the energy sector, and then you had to drill down and find out which companies or corporations you thought were going to outperform. And I think you have 2 challenges in that case, getting the sector right and then getting the company right. Now, at our firm, we have an economic slant to making investment decisions. And when we make a decision that a particular sector is in an expansion, then all we need to do is find the ETF that'll correlate with that sector. Makes our job easier from our standpoint. At one time, we were sort of joking around our office that stocks are going to be created for the sole purpose of being made into a basket that will then be traded in the form of an ETF. But the leveraged ETFs in the particular target sectors, I don't know that they're swinging the markets. I don't know that they increase the overall risk that sector had originally. What's happened is you can identify it. It used to be, the market was up, the market was down, the Dow, the S&P. And now you're able to say the financial sector is down 50%. You're hearing a particular sector, and it's implying that there's greater volatility in the overall market, but it's really just the volatility of a particular sector, not the overall market.
And I would say, to give a mutual fund perspective to it too, is that I think the intraday volatility at the end of the day, had so much more to do with mutual fund managers, given the structure of mutual funds, having to close their positions to meet redemptions that were coming in all through the day, that caused more of the end of the day volatility than any of these leveraged products ever could. Managers were out there getting redemptions and putting a stock out there 30 for a bid. Somebody get a hit at 30, 29, 28. End of the day comes like 23, 20, 21, just trying to hit those. And that's what was, I think, really causing a lot more of the end of the day volatility.
Okay. Leverage ETFs, is that a retail product? Is that a professional product? Yeah. You guys are looking at this all day long.
Yeah, I mean, there's nothing inherently wrong with leveraged ETFs. There is something inherently wrong with using them improperly. Mm-hmm. And they are trading vehicles. I was just on a panel with reps from DirectSheen and ProShares, who are two of the larger providers. And, the first thing that comes out of their mouth, this is not meant to be held longer than a day. These are funds that rebalance daily. They follow their index. They're using swaps and futures. And if you hold a daily swap longer than a day, then you've kind of violated it. And the issue, and we have a lot of material out there, and a lot of folks have written about it. So it should be easy if you look for it. It has to do with daily compounding, rebalancing. There is a volatility drag on these funds over time that is just a mathematical certainty. So if you're going to use them, you're going to trade them, you want to make a daily levered bet, that's great. If you hold them for longer than that, you've violated their use. And, it's kind of like trying to cut your birthday cake with a chainsaw. It's going to get messy, but your cake will get cut. You're going to have cake everywhere.
And I think that's the big message, right? I mean, options always had that kind of connotation as well until the OIC put into place a program to get out there and do thousands of different seminars for retail investors. So they understood how the structure worked, right, what the potential pitfalls were, how to use them in a portfolio appropriately. And a lot of the negative press, I think, that short and leveraged have gotten could probably be solved from some much better education, much better clarity on how it should be used, how it's structured, how it will perform, that it's not a long-term hold, it's a daily product. And I think that therefore segments and puts it in a clear space for how it should be used.
And I think I would like to add from a cost perspective, for any individual in the room who wanted to get access to 2 times or 3 times leverage, before these ETFs, your option was either to buy options and write call or put options, or go do a structured note or a swap, or do something synthetic, which was not exchange tradable and had counterparty risk to it. What these leverage products have done is about at 95 basis points, without going into any specific fund or metric, the average cost is about 95 basis points. It's giving you the access, whether you want 2 times leverage or you want 3 times leverage. It's getting that to you cheap. Well, there's no free lunch, as Wall Street says. There is no free lunch. And the free lunch part over here is, yes, you get that leverage if you hold it for appropriate time, which is, if you look at the FAS and FAZ, which is the Financials 3X funds, not managed by KBW, not sponsored by KBW or recommended, those funds trade almost 2 to 3 times their shares outstanding on any given day, and certain days it trades 4 to 5 times. That's telling you the fund is churning 3 to 4 times a day.
Right.
Going back to Scott's point, this is a daily day trader, minute trader, second trader portfolio holding rather than a traditional buy and hold strategy.
Even with that volume, which is heartening, it says that by and large institutions are, what's really driving these funds. I know there are individuals out there. I know there are advisors out there. Every conference we go to and we talk about it, eyes open up like you wouldn't believe. Like, what's going on? So We're trying to do education. It's been Morningstar's number one, education goal for 2009 to get that out there. And I think the industry's actually done a great job, really, really trying to get that, whether it's analysts or providers. So,
and the websites have changed. I mean, you can think about the original launch websites, and now it's very clearly in the titles now. It's a daily fund.
Right. Well, you make a very good point about it's providing leverage to a product that typically was in a structured note format. And I don't want to glaze over that too quickly, because part of the reason that the problem exists in the financial crisis that we're having right now is the products that were created and sold didn't have a standardization or a marketplace for price discovery. So suddenly they're called toxic assets and they're worth nothing, and et cetera, et cetera. So if you were to create an exchange, like the 3X version of the XLF, whatever it's called, and have it trade, as long as there's price discovery and liquidity, it's fine that it's 3X. It's fine that it has greater risk. I'm okay with that, as long as I know that if I don't like the position that I have on, I can get out of it, and they're incredibly liquid, and you can price it. So it's actually, I think, a poster boy for what can happen when you create an efficient market, regardless of what the product is.
Okay. ETFs in the options market we saw last fall with all the problems, the SEC regulations on short selling, individual stocks in the financial sector, hard to borrow, hard to locate stocks. Did market makers did they turn to ETFs as a risk management tool, as a hedging tool?
I find that they did. Certainly, you probably saw volume spikes in the ETFs during that particular time. And sort of segueing back to one of the things you were talking about before, blaming some of these ETFs for market volatility, I think that when they eliminated the short selling rule, because at one point they tried to blame short sellers for the market going down, as if people really believe that. I think this is a great point in case where it wasn't the tail wagging the dog as they so. And coming to ETFs when option market makers were unable to short certain names showed that if you can reduce risk by purchasing these securities, we're going to go ahead and do that.
Yeah, and I'd like to echo the point that I think the chair, the first day, the SEC chairman, who's actually yesterday morning session was, you need to go out and voice your opinion, because there's a session that's happening on Tuesday of next week where they're going to review the 5 rules, or the 5 options for the short sale coming back. And you have to remain cognizant of the fact it's always when the prices are going down, we talk about implementation of rules. We never do that when the prices are going up, right?
Unless it's oil.
Or oil companies, not the oil price. But that's a different way to look at it. I think what you have to be cognizant here is you need price discovery on each side of the market. And otherwise, artificial inflation only postpones the mere occurrence of an event at a later date, which creates a shock to the system. So, I mean, we saw definitely great move to the options. You've seen the 3X levered ETFs have good option volumes on them. That's just a mere function of the market. People saying, I believe there's an opportunity, whether it's ARBed, whether it's direct, whether it's beneficial, or your mathematical call on it, whichever way you look at it, there's definitely an opportunity. And you've seen option market making. The member firms have taken a very good look at the ETF marketplace, the options on the ETF marketplace, and have allocated capital. And that's serious money out there.
Yeah, and I think ETF options are the new index options, cash index options. I mean, I think it was in 2005, there were about 150 cash index options listed in the States, and that's down to about 100 now. And it's certainly clustered into certain classes. I think there's close to 300 ETFs in the States that have options trading on them. And to Scott's point, when anybody can surprise you on a call, you don't want to trade single names, right? You want to step back and you want to trade the indexes, take a thesis on the group, not on the individual name. And the ETF options have just, the liquidity has soared as a result of that. And I think that's nothing but a good thing.
One additional point to that, Jamie. On index options, you have to pay a royalty fee. On ETF options, there's no royalty fee for the exchange side.
Thank you for bringing that up again, yes. Yeah. Maybe
the most liquid
leave that to Bill Brodsky and Sandy to fight over for a little bit.
But, besides the short rule, what happened in October, ETFs actually served a very valuable purpose in a lot of less liquid markets, things like municipal bonds and high-yield bonds, where, even though there appeared to be a price disconnect between the NAV and the discount, many people, when you went and talked to them, said, look, the actual price discovery in the municipal bond market right now is happening in the ETF because that's the only thing that's still trading. And, whether you were a traditional fund manager or a pension, so many of them in their pricing grids, when they went to evaluate their own portfolios, were using the ETFs as the benchmark and as the price discovery vehicle. So, whether you're an individual investor with a laddered bond portfolio, ETF provide a great liquidity there. The fact that the NAVs and the trading prices disconnected as much as they had is definitely not desirable. But, the result was you could trade the MBB, which is the big municipal bond ETF that day. If you called up and said, I want to trade Orange County, nobody was going to give you a price. So if you needed liquidity in certain of these thinly traded asset classes, you weren't going to get it unless you had the ETF.
And that speaks to, again, one of the elegant points about ETFs. As an index provider, we've got a symbiotic relationship with ETF providers, but it gives investors an opportunity to avail themselves of, sometimes the flaky things, right? I mean, overseas, you can argue whether or not this is appropriate, but there are carbon ETFs trading right now. Yeah. Okay, so that's a very nascent market. Whether it makes sense for a retail investor is another issue altogether. But it provides a structure for somebody to avail themselves of a particular thesis. I think there's probably been maybe too many products brought to market. And I say that not because too many products isn't right, exactly. And the market will cull itself and pull back those that don't attract assets. Right. But the ability to continue to bring forth, some transparency and some facilitated mechanism to access a market is tremendous. And those that catch on will continue to catch on.
And you're making a lot of terrific points about the product itself. 10 years ago, you would talk to individual investors, and they all thought gold would be a good thing to add to a portfolio. Well, how did they do that? They literally would buy gold coins. Some more sophisticated investors would buy futures contracts. Now, the percentage of investors that have gold in their portfolio is largely due to the fact that there's a gold ETF or multiple gold ETFs. And you can have exposure to gold in your portfolio, which many investment advisors would say is a smart thing in a nice, efficient way. Now, I'm not commenting on whether gold is going up or down, but I too agree that it's a diversifier from traditional stocks and bonds, and now the average person could have that in their portfolio. And what we're seeing, and one of the things that we're doing at our firm, is just measuring the ETFs that are popular, that are big and popular. Forget about what they trade. Is it carbon? Is it bonds? What are the ones that the investors are going after? And let's do some homework on that, because the investor demand in and of itself is telling you something. And so, I agree with Jamie. Creating more of these things are terrific, and then letting the free market determine which ones succeed. And then it's interesting to see which ones are succeeding, and then you can drill down as to why. Why is the GLD gaining assets greater than some other ETF that might have...
IAU, for that iShares IAU gold ETF.
What is the reason behind that, other than just the asset class that it represents? And, Jamie, to use your word elegant, it's a perfect explanation and description of what these products are. They're elegant, and they're providing the ability for investors and traders and investment managers to diversify a portfolio beyond just, when I started in the business, it was stocks and bonds and some percentage. That was it. And I think you'll find it very hard to find a portfolio that's a traditional 60-40 portfolio these days.
And there's never a shortage of ideas, right? I mean, there's always infrastructure, SRI, whatever it is, there's always something new.
But I do think, Jamie, when you started off, with the elegance, there is actually, I think, a little catch to that, and that's where a lot of people are getting tripped up, is that sometimes the simplicity of especially a simple vanilla equity ETF can kind of fog over the fact that actually ETFs can be fairly complicated at times. There are remarkable differences. There's 5 different oil ETFs, and they use different structures and have different taxation, and there's ETNs and ETFs, and so there's a lot of different issues, between GLD and IAU. You ask, why is one better than the other? Well, one's physical and one's using futures and forwards, and that's a big difference.
But that puts the onus back on a firm like Morningstar to, it used to be, well, why should I buy IBM over Dell?
Right.
And so the research reports and the companies would, generate a lot of paper and a lot of information. Well, now it's basically you're doing the same type of homework to tell you the difference of why GLD is a better opportunity than the XAU.
So is this where I get to put a plug in for?
Yeah.
and we do that at Morningstar. We actually cover 300 ETFs, and we talk about the portfolio construction and
sales page.
So that's all in there. So we cover a lot of it. So you can go there if you have questions.
Do you have a business card?
Just, I think one point.
I wanted to call that out. It's a nice softball. I'm like, we do that.
I think one critical factor with any ETF in the marketplace is first to market. People do not factor that notion, but first to market is a very key factor. The adaptation of any first ETF and you can look at oil, gold, any sector ETF you want to look at, XLF, SPY versus IVV in Canada, the same S&P 500 index. One has 65 billion in assets, the other has only 11 billion in assets. First to market is the most critical point in any subsector, sector, strategy, commodity, whichever way you look at it.
I'm not 100% sure that I back that. I really think that the trading part of it is what makes it successful. I think if the traders are going to trade it, we've just discussed how the FAS or FAZ, whichever the triple levered one is an incredibly popular product. It's because the traders are trading it. I don't think portfolio managers are buying it, nor do I think average investors. So if you create an index that the traders trade and create liquidity, then the investing community comes. Then that's why they buy the SPY over the less liquid one.
No, it's the same index. Look at the same example with the 2X. Pro shares over IDEX.
Yeah, well, we've seen a migration to the SPDR and the iShares version of the S&P 500, which has the ticker IVV, are tracking the exact same index, except because the SPDR is older, it's actually not as well constructed as the IVV. And so, the advisor world, the investor world versus the trading world, we've actually seen a very bifurcation of two different tools. The advisors say, look, IVV is what I want to hold for the long term, and the SPDR is what I want to trade. So if I need to move $10 million today, SPDR. If I'm going to put money in and sit on it and use asset allocation, then the IVV is
No, I agree, given two very like indices, the first to market name recognition is going to probably lead. But if you're coming up with something new and you're coming up with something new, it's the one that the traders get behind.
Right, but that's my point, is that the SPDR has actually been seeding assets to the IVV over time, that the IVV, the more buy and hold, has actually been gaining ground. So first to market within limits, because you can't just go out and price an ETF at 200 basis points, because I'd come out with one at 20 and this will be over in a hurry.
You guys have a vested interest in this. This is your business. Where does it stop? Is ETFs, are they going to take over the equity markets? Are they going to take over the option markets? I mean, how many is too many, and at what point, do they stop creating components of these ETFs?
Hopefully never, and let the market kill them themselves. I do think that they take over. I think that they will eventually equal the mutual fund assets, and I think it'll be where the investing community looks at. Instead of what's a stock tip, it'll more what's an ETF tip.
Well, and actively traded ETFs are coming, and there's already, Grail Advisors out there. They're going to launch on May 4th a fund-to-fund sponsored by American Beacon. So you're going to have a mutual fund-to-funds in an ETF wrapper. And then, they're saying that they've got managers lined up to actually do single management in an ETF and deal with the daily disclosure. I think it's actually foreseeable that, 4 years, 5 years from now, you really start to become wrapper agnostic between, at least on some of the more buy and hold stuff, between mutual fund and ETF, and it becomes more active versus passive, and then there's these different vehicles with different tax treatments, et cetera, to deal with that. So on that front, the evolution is going to continue, and I think really accelerate.
Yeah, I've seen two surveys recently, one from Schwab, one from Ridex, that 80% of RIAs now consider ETFs to be their first choice for asset allocation. And yet that uptake has been sort of slow, so there's enormous growth potential there. As you said, active is an enormous potential. New product development from all these new issuers is very, very significant. The U.S. the domestic market is the most mature ETF market. Right. Europe's not far behind in the number of listings, but only has about a third of the amount of assets that the U.S. does. So that's historically been more of a structured product or certificate market. So there's enormous growth potential there, and we're starting to see more cross listings. I mean, even Abu Dhabi is on the docket for listing an ETF in the not too distant future. So the whole structure is getting much greater uptake globally.
I think the whole paradigm shift is happening. Is ETF is now being relabeled as ETP, exchange traded products, whether it's exchange traded fund, exchange traded note, exchange traded commodity, or exchange-traded leverage inverse, which is probably a new classification, because every ETF is not the same risk. There's inherent risk, because if you're an ETN, you have counterparty risk. If you have ETC, you have a referential index risk. You have different risks with each different product. But to get to your point back, Andy, this is a market which has taken a lot of time to get to where it is today, but to take the next 15 years, it'll take a much bigger leap of faith than just saying, this is your survival. I would go with Rob's point over here, saying this will be probably a industry of choice and might overtake mutual fund industry, much to the surprise of many people in this room, in the same amount of period it's taken to get to what it is, which is 15 years to get to about $500 billion in assets. The next 15 years, it'll probably be much bigger assets. And that's my personal view.
What does it mean for the options market? I mean, you have huge infrastructures, market maker models, strategies revolving around single stocks. You've seen a shift at all the exchanges to more index option trading. How does the industry deal with this growth, potential growth, and how do they factor it into kind of how they trade and what they do?
Yeah, I think this is terrific for the option industry. If you look back at the evolution of the option markets, back when there were just calls, there weren't puts, and they were on single names, when they created options on the S&P 100, it became the magnet, if you will. And if you being from Chicago, if you would have looked at the pits, the ones that were growing the fastest were the index ones, the OEX and some of the banking indexes. And so that became really what forced the volume and the efficiency was that. So the greater a number of indexes or ETFs that are created, I think the option industry is going to embrace it because back to the tradability and the arbability. Wow, here's an index that I can buy some options on, but I can also buy some options on some of the underlying, and I could get half the exposure or 1.5 times the exposure and have sort of the ETF as the base of what the strategies that are being created revolve around. So for every ETF that becomes optionable, all the components of it become the benefactor of that.
Absolutely.
Yeah, and I think it's wonderfully complementary. And I mean, the ETF volume on ETF options has been the biggest growth area, one of the biggest growth areas in recent months. I mean, the volume's exploded, and I think the more ETFs that trade, ETFs have historically been a very retail-oriented product. Now there's much greater institutional uptake in the hedge fund space, and it sort of parallels the growth in the option business, right? But now they can complement one another, and I think a lot of the online broker dealers have just set up tremendous front ends, are great at educating and offering the opportunity to kind of overlay strategies within one another, and foster greater usage amongst the two different product types. I mean, ultimately, I think it's just a great thing.
Yeah, the democratization of asset classes that ETFs have brought, it will, because they're traded on the exchange, to your point, is going to allow for the democratization of options. So definitely a great compliment.
I'll take this different side of the equation here. I think the exchanges have built the capacity, and I think there's a need for some level of that capacity fulfillment. And I think options on ETFs perfectly fit into that trap, because you have index options, which this year I've been told, I've not checked this, that the index options are on a decline, but ETF options are on a rise. So I think it's a complementary strategy. Wherever you will see you have an opportunity to make money, and going back to the earlier point, it's all about, if you have 2 cents to make, you will go after that. And I think ETF options perfectly fit into that strategy because of the underlying securities are already very liquid. There's already equity options on them. Most of the indices are very well established. That are the highest volumes. And the newer strategies that are coming in are filling in the gaps for the core holding or whichever way you want to put in a portfolio. So I think there's a very big rationale why these are very good products. And I believe in this conference, bringing this discussion from Todd's point, I think we'll bring in that message across to various members who are on the fence, who have not been able to either make a decision whether they want to be in this side of the business or not. Hopefully we've cleared some doubts why this is an attractive business model.
Andy, I want to kind of tease something back up. Maybe I'm going off the sheet here, but the active managed ETFs. We know a lot about that. We've looked into it, but I think it takes away from what the ETF is supposed to be. And now what you're doing is you're taking a money manager strategy and just creating a wrapper for it. And I think there should be a distinction between Joe and Bill's ETF, which is their strategy just in this wrapper that traditionally would have been a mutual fund. And if you do that and it starts to compete with the mutual fund industry, you're just looking at the wrapper behind it. A mutual fund and active managed ETF, I think, are going to be incredibly similar products. And from the investing community, I think it would be incredibly challenging for an investor to pull up Joe and Bill's ETF and have an opinion on it other than, well, I think these guys are smart guys and I like their strategy. And the goal, I think, of an ETF, and then options on ETF sort of helps expand that goal, is to be able to have an opinion on coal or carbon or solar energy or the inverse or even the 3X version of something. And so as the industry starts embracing things that I think take it out of the rationale and the reason that the ETFs got created, it might not be good. I think it might take you away from, I'm going to use Jamie's word again, the elegance of the product itself. And so I know we left that topic, but I think it's something that needs to be addressed, because from a trade, are you going to buy options on an ETF of somebody's strategy because it's active?
I hope not. I hope they don't do that.
But then how do you hedge that? I mean,
education part of it. I mean, there will be called track records. Remember, with any actively managed mutual fund, unless you have a track record.
It's different with a mutual fund, because that's what you're buying. You're actually going, I'm going to give you money in a pooled source because I think...
Which is why you've seen actively managed ETFs so far not take off. Because people are looking at that and saying, and asking the questions, where's the transparency? Where's the tax efficiency? Those same reasons why people are buying ETFs in the first place.
Some of the dynamic ETFs, the PowerShare stuff, have hundreds of millions of dollars in them. I mean, I would say that they have taken off.
Well, I don't know, hundreds of millions of dollars in
the ETF space. I mean, that's a very profitable product. That is a very well adopted. That's a very liquid product.
I'll support your thought in that. We again, as an index provider, we often feel like we've carved up the universe about as many ways as we possibly can. And one of the areas where we start to see kind of a lot of interest, and this is a double-edged sword, I think, but a lot of interest is coming in enhanced indexing, taking and indexing, but model-driven to enhance the selection or the weighting of the index, right? Okay. Again, double-edged sword in that people are looking for that opportunity for outperformance still within the confines of sort of an objective, rules-based, transparent methodology. But the other side of it is I think a lot of people are really distrustful of models now, because it works until it doesn't work, right? So, that's definitely, there's movement afoot to that. And one point, if I can make real fast, that I find to be a benefit of ETF options is, especially when it comes to tracking foreign markets, right. The bar for a new index contract, be it a cash option or a future, on a foreign index is just, or on any index, quite frankly, is huge, especially for foreign index. And when you look globally, you can count on one hand the number of successful foreign index contracts that trade in another market. I mean, there are almost none. I mean, there's really very, very few. But by taking the option on an ETF structure, you can now trade options on Malaysia, for example, and affect a leveraged or short position using options that you couldn't do with another contract. And I think that, for people in this marketplace, that provides a great deal of flexibility that heretofore was unavailable.
I agree.
We've got a couple minutes left. I'd like to open it up to the audience if there's any questions. I believe there is a mic floating around. There's a couple questions up front here.
I'd like to know if any of you have any sense as to what extent options volume is driven by hedging activity and what the breakdown between retail and institutional activity might be.
I'm happy to say I have absolutely no idea.
Let me ask it in a more general sense. I haven't heard much from the panel with regard to ETFs and their use in hedging, and it's our experience from looking at option activity that a large constituency of option activity, big spikes in put option activity, for example, in ETFs, for example, in the energy sector, the XLE If you look at the put volume spike in 2008 right into the top of the energy and commodities peak, it was really not speculative put buying in the sense that people were bearish. It was put buying associated with increased exposure on the long side, probably to selected individual stocks in that sector. I think it's a huge use of the options market, and I think ETFs actually are not necessarily obliterating the stock-by-stock distinction. They can actually enhance that from the standpoint of you can have a selected view on stocks in a sector and you hedge your position with the ETF to eliminate the sector-specific risk. I think it's a pretty popular activity.
And you're right. And many hedge fund managers that we speak to would have positions in a particular name in the financial and in the energy sector specifically. I recall examples, and then hedge that by either buying puts on an ETF or outright just shorting them. You're concerned about your position in Bank of America last year. You want to hang on to it. You think your research shows it's going to outperform. You buy puts on the entire sector itself. A lot of strategies that just look to outperform the index, and put activity or selling calls or selling short the ETF creates a lot of volume.
And we see that, one thing when you look at the fund flow data in ETFs, when people short an ETF, it actually shows positive fund flows because they create the unit to then lend it. And so, I was looking at the back end of last year, and I kept seeing the iShares Brazil ETF, and every month it was having positive fund flows, and every month it was losing another 10, 15%. And I was, are people dumping the stocks and going into the index, or are they buying? And the reality was people were shorting the Brazil ETF, which made it look like people were investing in it, but really it was the short, and then as we saw the short roll off. And we saw something similar with the XLF, earlier this month, where, reporters, look at all the, the negative fund flows in the XLF, but it's up 30%, people selling at top. What really was the shorts were collapsing their positions, and so...
I'm going to take this opportunity for a shameless plug, but only because it's relevant. We have a website that tracks the flows. It's called etfport.com. I think the creations and redemptions of ETFs are a very important tool from a trading standpoint, and we track that stuff at etfport.com. It's free, so it's not a real plug, but it's important information.
I think one thing people have to remember, and this is the SEC mandated rule, before September of last year, you could have shorted ETFs without actually having a borrow, and the synthetic borrow could have been a put or a call option. The reverse of the buying the stock and selling a call or a put, the reverse of that strategy was easily possible without actually having a borrow. Since that rule has been enacted, if you look at September 19th, just as a date of reference, post-Lehman crisis, post-everything else, you saw a huge amount of ETF creations happening, and which is why every ETF that you see a huge creation, and which is again, looking at the financial sector or whichever sector you want to look into, you're seeing a lot more creation volume behind short because you cannot be naked short or use a synthetic strategy anymore. You have to have a borrow for shorting the ETF. We have a few seconds left, but if you have any...
I think we're going to round it out here. If you have questions for the panelists, please, after the panel here, they're going to be around for follow-ups. I'd like to thank, first of all, the panelists for making their time and experience available, as well as you all for staying on such a nice day and listening to what they have to say. Thank you.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated, all rights reserved.